So I think you know what you're really asking me here is to look at the technicals and then to absorb the potential further negative news from the Fed this afternoon. So what I would do there is say, well, what has shifted since last night? There has been a lot of deleveraging for players that have been positioning long in the derivative markets over the last couple of weeks. We've seen that overnight. We've seen that throughout today. There is negative momentum in the market. I will tell you that I would expect that the market will be heavy through the close unless there is something from the Federal Reserve that kind of reverses that Brainerd bombshell from yesterday, and I don't think any of us can expect that. So I think from a technical perspective, the best you hope for is that the support that resides with the 50-day moving average down at 44.20 for the S&P and a previous swing area at 44.15, you hope that that holds by the close today at 4 o'clock.
It's funny, Steve, you know, this notion that, and we've been hearing this now for many, many weeks, this idea that the Fed is going to come to the rescue and it's going to pacify everybody, it's going to make you feel better. We've expected it, didn't get it. Expected it again, didn't get it again. But why would we assume that we're going to get that today, Weiss? And by asking you whether, you know, we think that the market is prepared for a much more hawkish minutes than we've been used to, you know, I don't know if I'm really talking from a technical standpoint. I'm just talking from an expectation standpoint, and the idea that you brought up at the very top of the program, what's in the market, what's not in the market. It's clear that the market wasn't expecting somebody like Brainerd, right? The picture of the doves on the Federal Reserve being as aggressive as she sounded yesterday. So what does it mean for today?
So if you take a look at the last, actually, we just passed the 13-year anniversary in terms of when the market bottomed after the financial crisis. So for the last 13 years, the Fed has always come to the rescue. So it's like Pavlov's dog. Market trades down 5 to 10%, and investors hop in because the Fed is coming to the rescue. Well, the Fed's going the other way. And what Steve said, if you really think about what Leisman said, is that the Fed is using the market as a tightening tool. So they're not going to come to the rescue. And I've said, and others have said, that Fed put doesn't exist anymore. So, look, I think the bar's been set.
Not yet. Maybe at some level it does.
I don't believe they will. Yeah, I think you need more than what is somewhat of an orderly sell-off in the indices. But keep in mind, the stocks have not been an orderly sell-off. They're down 40, 50, 60% on average. So it's somewhat illusory to just say, hey, the market's only down 10%. You could only go down another 10%. Well, that's just not factual because that doesn't reflect it.
Of course.
But in terms of what the market will do when the Fed minutes come out, I think the bar's been set pretty high after Brainerd's comments yesterday, which, by the way, may not be disassociated with what the Fed minutes will be. So the market, I wouldn't be surprised if the market traded up on it. I don't expect it, but right now, short term, you know, who knows in a day. Going forward, I maintain still that the market's not prepared for what companies are going to say because everybody talks about how great the economy is. So that's the next flashpoint.
Let me do this.